All right, listen, we may have found the bottom of this horrible, terrible sell-off that we've seen. In fact, Joe, looking at this, I mean, we're up nearly 1.5% today. Gold is collapsing by 2.82%. Silver is down by, or silver is now up slightly, 19 basis points. But oil's the real story of the day, right? Down 10% today. All kinds of stuff is going on. And right, it can be extremely difficult to trade this market right now because of the fact that Donald Trump can sit on his toilet and with his two thumbs completely change the economic outlook and completely obliterate your trades. It makes it super, super tough. So for you and me, we have a plan in place, and you're going to have that plan in place to be successful. Because as exciting as it is, Joe, look at this. As exciting as it is to see all this green, right? I can tell you with 100% certainty, and when I say 100%, this is no fake guru talking, right? This is absolute mathematical facts. The 10 EMA is under the 20 EMA, prices under the 50 EMA. That is conclusively a bearish trend. And prices under the 200 EMA, or I should say 200 simple moving average right now. What that means to you is the direction is down. How long is the direction going to be? I don't know. But then you get a day like this where people lose their minds and they're like, oh my God, it has to go back up, right? Joe, I wonder what it looks like if we go to like the 1 week performance. I mean, if it looks this green today, it's got to look this green over last week. Oh, ooh. Well, maybe it's just a fluke. Let's go to 1 month performance, right? So remember, this is today. Everything is hunky dory. I'm in such happy lands, and then we go to the it just keeps down. Oh my gosh! If only I had Ovtlyr to know where to get in and where to get out, then I wouldn't have to stress like this. Joe. In fact, I just came off a week of spring break, and I'm about to go on another one in a couple days. And I have zero stress. In fact, Joe, I've been paid literally by the stock market every single day that I've been on vacation is paid for my vacation. I haven't done anything. Man, it's good to be an outlier. Man,
yeah, it is good to be an outlier. I'm in the same boat, Chris. Although when you're sitting in cash, you're only making a little bit of interest, but I'm not losing money. And as you said, it's a small amount of money paying for zero stress. It's amazing once you become an outlier how much more enjoyable it is to trade.
That's right. Sit in cash and don't F up your portfolio. Now, I found this video I want to watch with you called This Technique Changed My Trading Forever. And now is the perfect time. It's just 82 cents a day. It's the change in the couch. Exactly. Now is the perfect time. If you are stepped out of the market and you aren't taking any sort of market risk to evaluate, hey, what can I do to my trading plan? How can I improve upon it? Right. So here is a video we could watch together. Maybe we'll see some improvements. In fact, Joe and I are both competing in the U.S. Investing Championship. I got my shirt. Did you get your shirt yet, Joe?
No, not yet. It's in the mail, though.
Dude, I've been walking all over running errands today, showing off my shirt. I'm so stoked to be a part of this. But let's watch this, and maybe, just maybe, we'll have an idea to improve our trading plan.
This formula changed my trading forever. This formula changed my trading forever.
Position size. Volatility. Huh. You know, what's interesting about that, Joe, is I have been preaching position sizing based on volatility for ages. Literally ages. In fact, I have a whole slide about this. Where's the slide? Here. How do I calculate my position size? First, you take your account balance and you multiply your risk percent. So let's pull up a new spreadsheet here and let's go to your account balance. Okay, so let's say you have 100,000 and your risk percent. Let's say you want to risk 2.5%. Okay, so $100,000 and 2.5% of your portfolio. So you're going to multiply A times B. So that means in any one trade, the max that you want to lose is $2,500. All right, makes sense?
It does.
Okay, next, you want to divide by 2 times the ATR. Now, what in the wide world of sports is the ATR? ATR, let's go to the SPY, is your measure of volatility. And you can see the measure of volatility on the SPY has increased tremendously as the market has gone down. You'll also notice, if we zoom out a little bit, in the 6 months where the market only went up, volatility actually crashed down hard, big. So the average range, the average true range was roughly 4.8. Okay. That means the average candle size, top to bottom, left to right, 4.8. Now, the average true range is 994. Let's round it to 10. So volatility has doubled. And since volatility has doubled, if you're keeping the same position sizing, you're actually trading with twice the amount of risk. And I'll show you exactly how. So let's say that your ATR is 9.94 today, 9.94. That's your ATR value. And you can get that free on any broker or any trading platform. So you then take this value, you divide by 9.94. Let's put it right here. Equals this divided by this means I could pick up 250 shares. I'm sorry, 2 times this. Hang on, I almost messed that up. Equals 2 times this times 2. There we go. Now we equal this divided by this. There, 125 shares. Okay, 125 shares. We got to round down is 126 shares in this case. This is how much your position size would be in order to get this to work. Now, how does this work? So if you have a stop loss that's 2 ATRs away, and in fact, what's interesting about that is, that's exactly my 2 ATR stop loss. Weird how that works together. Okay, so 2 ATR, right? Your account balance times your risk percent divided by 2 times the ATR gives you number of shares. In this case, it's 126 shares. Let's go math this out. Ready? This is actually pretty cool. Once you see this on the chart, you're gonna be like, oh, I get it now. So let's go down $10. Okay, that's the first ATR. Now let's go down another $10. That's 2 times the ATR, right? That's quite a lot. That's pretty huge. And remember, this is double of what it was just a few weeks ago. Hang on, I have a template for this. Make a 2 ATR stop right there. All right, so let's say you got in, opening here to here, right? This distance right here is going to be $19.88. It's 20.06, but it's rounding. So this is the amount that you're willing to lose on a per share basis. Okay, I'm willing to risk, we'll use round numbers, $20 per share to find out if my trade is going to work or not. If it doesn't work, I'm only risking $20 per share to find out. Okay, now $20 per share times 126 shares is going to get you to $2,500. So you've risked 2.5% to find out if this trade is going to work. That's how it works. That's how it all works together. Now, let's take it a step further. And let's say that you want to use options, right? Number of shares, which you already have, divided by delta. What delta are you going to use? I like the 80 delta. So you could say the number of shares divided by 80 delta gives you 1.57 contracts. You could round up potentially and say 2, and that's it. You have a $100,000 account. You're willing to risk 2.5% to see how it's going to work. And you're just taking 2 contracts, Joe. Not 20, not 200, 2. Because we're trying to manage the risk here, okay? Now, that is how I calculate this. And this calculation came from a market wizard. In fact, the very first billion-dollar hedge fund manager used this exact framework right here to get his position sizes. And if it worked for him to get up to $1 billion, pretty sure it's going to work for you. All right. Doesn't mean that every trade is going to work, but this position sizing is variable based on your volatility. Now let's go back over to here where it was about 4.8. And let's say, let's recompute this. Okay. And let's do 4.8. Right. Now we're looking at 260 shares. But you know what, Joe? Volatility has doubled. Remember, this is the only thing different between these two. The ATR value. And yet you're giving it $9 of risk. $9 of risk. So what you're doing is you're saying, you know what, that's a long way to go down. Let's do this here. So we'll go about halfway, right? But in reality, Joe, you're taking even more risk because A, your stop is closer, which makes things harder. And B, you're trading with a bigger size, which means you're actually taking more risk. So you actually have a 50% bigger size in this case. So both of those are going to work against you in this case. A bigger size with half of the stop here. Now, granted, the idea behind this is you're still getting $2,500 of risk, but you're only giving it one ATR to find out if it's going to work versus two. So I've rambled long enough. Let's keep going. We got 1 second in the video and I started rambling. Sorry.
If you've been struggling with wild swings in your P&L, up 1 week, down the next, like I was, it's because you don't have one of these, a volatility target. This one formula single-handedly took my...
Now, granted, I'm very interested. If this leads me to somewhere where I can make a change and make more money, I'm interested in learning.
Portfolio from chaotic swings to consistent, controlled volatility in the span of a few weeks. And it's the thing most traders are completely ignoring or they've never heard of it. A lot of people have been asking me, how can I size my positions and manage risk across multiple strategies?
Who's actually asking you that? Nobody asked that. I've been doing YouTube for 7 years. I've made 2,700 videos. Like literally nobody's coming up and be like, hey, how many shares should I get? Nobody's saying that.
Because I run over 10 strategies that are fully algorithmic and also been asking for a deeper breakdown of this. So in this video, let's get into it. Now, the first thing we need to talk about is what is actually volatility. So to make sure we're on the same page about it, I'm going to break down what volatility is because most traders use the word without really understanding it. Simply put, volatility is just a measure of how much price moves over a given period. So if a stock moves 2% a day on average, it's more volatile than one that only moves 0.5% on a day. Now,
I remember going back to the SPY example, right? I'm using just the default 14 days. Maybe there's a better outcome. I don't know. But this is the average true range over the last 14 candles. So that's how I would measure it. And of course, everyone's going to have a different measurement.
Two main ways to measure this. You've got standard deviation, which measures the data dispersion used for volatility. And you've got average true range, which measures the price range.
Hey, how about that?
Used for volatility as well. Now, ATR looks at the full range of each candle, so the high and the low of it, and the previous close, and then averages that all out. Now, professional quants normally lean more to standard deviation, while retail traders normally use ATR. Honestly, they're measuring kind of the same thing in slightly different ways. And now I've taken this from Robert Carver. He has a great blog.
And listen, you can do whatever you want, honestly, but you know how easy it is to just like double click my screen and ATR's there. It's way easier.
No, I'm thinking that the double clicking of the screen itself is a pro tip because I didn't know that, Chris. You just taught me something.
Pro tip. There you go. Yeah,
There you go.
It's one of the lower indicators. You can just double click the screen, it pops up. Double clicks, it goes away.
That is handy.
I know, right? Dude, TradingView is like super powered. It's OP, as the kids say these days.
Yeah,
it's goated. I heard that last week on spring break. This is goated. Yeah.
I'm thinking of another pro tip too, Chris. If people are, if people are looking at your if people are looking at your slides and doing screenshots, I'm thinking there's a better way to get those slides. How could they get it?
Oh, you mean like literally going to every video that we produced in 2026 and it's going to be right there linked for you forever? And it's the exact trading plan that I'm using in the US Investing Championship.
There you go.
And there's nothing, there's no paywall, there's no sign up, there's no masterclass, there's no BS, there's nothing. You just click it, you got it. It's just that simple.
Awesome.
And he has actually a topic around this complete conversation. So I'll leave that more to him as he's already written a great blog piece around it. But primarily what he says is that on most future data sets, standard deviation is going to equal ATR times 0.875. This is more an empirical rule of thumb, not a completely universal factor.
Ooh, there's a pro tip right there. Pro tip. I don't have to push that button all day, but this is the first time I've heard that. Standard deviation is roughly 87.5% of ATR value. That's kind of cool.
But this kind of shows how most of the time they're quite similar. And the most important thing is you just pick one and then be consistent with using it. For what we're...
Dude, that's what I say. Is that not what I say? I don't care what you do. Just pick something and stay with it, right? Because most people bounce around. They have no idea what they're doing. And it's okay to make changes. I want to preface this and say it is totally 100% okay to make changes, but you need to make changes on your plan, whatever, or take my plan. I don't care. Make changes based on a data set that says, you know, let's say you had 10 losing trades in a row. Was there a flaw in the plan? Right. And you can go back and you can say, okay, based on this or that, there actually seems to be a flaw. Maybe I can change something versus I can't find any reason why these didn't work out. It's just a string of bad luck. Both of these can happen. Absolutely can happen. A lot of people, they get one loss and they're like, no, this doesn't work for me. And they throw a tantrum, right? But they don't have the consistency and discipline to be successful anyway. What are they even doing?
We're about to do, either one completely works. Personally, I normally use ATR, just it's been the way I've normally always used it, but you can also use standard deviation as well. Now, the first thing we're going to talk about is volatility stops. So if you've ever set a stop loss at a fixed number, like 2% below your entry or 50 pips below, you're probably doing it wrong, in my opinion. And I don't say that lightly. I used to do the exact same thing. I had many strategies where I would only use 10 points or 5 points of stop loss. And a lot of times they actually looked okay on a back test. But the biggest issue is a fixed stop treats every market the same. A stock that moves 5% a day is completely different than one that moves 0.5% a day. You can also
Or 5% a day on one stock is very different than 5% in another stock, right? Absolutely different. And that can be humongous swings to your portfolio. It looks like he's got an ATR stop right here, which we did back test when we were coming up with plan M, and it actually performed less. Like this is good, but it was not optimal. So we did not use this. So for anybody who, I know you're already thinking, oh, maybe I should use this. We already back tested it.
translate this between markets, right? Like trading bonds comparing to trading NQ is a completely different market. And if you're using the same fixed stop, it's just not going to work very well. This is ideally why we want a volatility based stop that adapts. When the market is calm, you tighten your stops. When it's volatile, your stop gives it more room to breathe. The most common way to do this, and this is how I normally do it, is just,
and again, like that's our example right here. The market, the SPY is more volatile. So we've given it way more room to breathe than if we had the smaller stop right here. Right now we've pulled in our position size. Right, we have a wider stop and a smaller size versus a bigger size and a tighter stop. Right, both of them are going to get you to the same place, but both of them carry very different risk parameters.
Just using ATR trailing stops. So you can take the ATR amount on that particular candle of your entry, whether that be a 14 period ATR or whatever you want to use, and then multiply it by some factor. Normally it's about 1.5 to maybe 3 if you're going for like a wider stop, and that gives you the distance from your current price to your actual stop level. Now this.
So for us, what we've found and back tested was a 2 ATR stop was ideal. Now, that doesn't mean every time we get out, it's a 2 ATR loss. In fact, I have all the data, Joe, right? On winning trades, the average move down at any point during the trade was 0.421 ATR. So on a winning, and remember, when this happens at 0.42 ATR, we don't know if this is going to be a winning or losing trade yet. We have no idea. But the average up move at any point during the same trade, 3. So on average, moving down less than half an ATR for a winning trade. But at some point in the life cycle, on average, going up to 3 ATRs and ending at 2. Now let's look at the losing trades. The average down move, the average maximum down move, 1.59 ATR. That's less than our 2 ATR stop. The average up move for a losing trade is 0.6, which is why we start looking to roll as soon as it hits that first half ATR, because we don't know if this is going to be a winning or losing trade yet. But if we roll as fast as we can, we're taking risk off the table immediately. And it may still be a loser, but it'll be a smaller loser for having done so. And then the average trade for losers actually ends up at 1.38. Now, this is using all of these exit criteria. Let me back up a little bit. All of these exit criteria doesn't mean every losing trade is going to hit the 2 ATR stop, right? A losing trade can have any one of these things, including a 3 ATR midday emergency exit. Yet the average ATR on a losing trade from start to finish, 1.384. Does this make sense? If this is making sense to you, Joe, as well as everybody watching live, do me a favor and hit a thumbs up for me. Hit a thumbs up for me. That'll make life a lot easier. Is it making sense, Joe?
It does, yeah. And I'm glad that you mentioned that you created a signal based on the half ATR roll point, and now you've explained why you have that signal. So great content.
I try.
This is more commonly used in trend following strategies because it lets winners run while still protecting you from trend reversals. But you can use it in other scenarios. Sometimes it does work well in mean reversion strategies. You're just obviously going to have a lot tighter of an ATR, so normally like 1 or maybe 2. But in trend following, you definitely can get up to 3 and maybe even more. Now we're slowly getting to the...
Yeah, bro, you can get up to 3 or more, right? Easy. Right? That's the average. Joe, on the back test, dude, there was some that went up like 30 ATRs. I'm not joking. 30 before it hit one of those exit signals. Now, there were some that actually, I mean, they will blow through your 3 ATR emergency exit, and there's nothing you can do about it, right? But that's why we let it run 30 ATRs, and even when that crashes through your 3 ATR, right, one of them is going to pay for 10 horrible losers, which is pretty cool, right? Mm-hmm. And that's the objective with trend trading and the kind of trading that we do here at Ovtlyr, is we want to let our winners run out of control and cut our losers short. I see lots of great thumbs up coming through on the chat. Lots of great thumbs up coming through on the chat. Thank you, guys.
the juicy part of this video, which is the idea of using this sort of volatility to control your risk on a single trade, but you can actually take that exact concept and apply it to your entire portfolio. So let me get into how you can do that. This is what is traditionally called as volatility targeting. Some also call it inverse volatility, a couple different ways of naming it, but normally if you type in volatility targeting, it's going to discuss this particular topic. And the reason this concept is so important is most traders have a portfolio where the risk is all over the place. One week, your portfolio may swing 5%, the next week it barely moves at 1%. And this is because you're not controlling how much risk you're actually taking. You're just really along the ride with your particular strategies. Volatility targeting completely flips that. Instead of letting the market decide how much risk you're exposed to, you decide. You set a target, for example, at 10% annualized volatility, and you can adjust.
Interesting. Okay. So the way that I like to look at it is if I know what my average loss is using this information, then I'm going to try and aim for that or better. If I know what my average gain is here, I'm gonna let that run. I'm not gonna stifle this. But I do want to stifle my losses as they work against me. That's what we're after here. Keeping our losses in check, in line with our expectations, letting the winners do everything they can. Which I kind of think is what he's talking about.
Adjust your exposure so that your portfolio stays as close as possible to that level at all times. And this does bring up really one important topic in trading. You can never really control your return profile, but you definitely can control or at least try and maintain a risk profile. And if you...
Is that literally what I just said?
Yeah, I heard that somewhere.
Yeah, literally. It's almost like this kid's a professional investor too. I don't know.
You can be in control of something in trading. I would always incentivize to be in control of it. You don't want risk to get out of hand. And if you can control it using methods like this, volatility targeting, it's one thing that can completely change your trading. Now let's get into the formula. To be completely frank, the formula might change depending on how complex you're doing. I'm going to break down a very simple method of it, but obviously from there you can improve it. Primarily what it is you have target volatility divided by your current volatility. So for example, if you had a target vol of 10% and your current volatility measured is 20%, you would then halve the portfolio. So you'd only invest 50% of your capital. Whereas if you still had that 10% volatility target, but your current volatility is only at 5%, then you actually maybe want to take some leverage. You'll be maybe 200.
Just trying to wrap my brain around this. Target volatility, which I assume is something that you pick, and that's fine, however you pick it. Measuring your current volatility. I'm curious to see how this is calculated. You invest half of your capital in a single trade? Yeah, that feels dangerous AF.
Even more dangerous though is the next example where he's using leverage.
Yeah, I don't know. Let's let him cook, as the kids say these days. Just let him cook.
100% invested. Now, the thing to actually use this formula is you're going to have a way to measure volatility. There's a couple of different ways to do this, but typically you can use the past 20 to 30 days of returns and calculate the standard deviation and then annualize it and do daily standard deviation times root 252. So because 200.
The F did he just say? I don't have any idea what that means. I just got itty bitty baby brains over here. Make it simple for me.
52 trading days. Some people also use exponentially weighted moving averages or EWMA with a decay factor of around 0.94, which just puts more weight on recent days and gives you a smoother transition between volatility regimes. This does actually kind of matter in live trading because ideally you don't want your leverage jumping around erratically. You don't want to be one day, no leverage at all, and then you would be like 5x leverage the next day. That's not typically what you'd want. A couple of important details about this is first, you'll actually want a cap for your leverage. You don't want the formula telling you to go, 5, 10x leveraged because volatility has dropped a lot on that particular day or a couple of days. That's often how a lot of accounts blow up, and when that switches, it can be a very nasty switch on your portfolio. Also,
I feel like he needs to learn my formula because his formula feels really, really risky. Like really, really, really risky here. Now, granted, I don't know how to calculate all those numbers. That's far too advanced for my baby brain. This is what I do over here, right? And listen, if it worked for a billionaire, I guess it'll work for you guys, right? I mean, like I say, if it worked for a billionaire, I assume that it would work for you without having to overcomplicate it. But yeah, you can get this for free. Just click it, you got it.
Also, some funds set a minimum floor, so you're never actually fully out of the market, right? If it's too high volatility, maybe you have a floor like you're always going to be at least 20% allocated, etc. Second, you don't want to rebalance every single day. Sometimes it does make sense depending on your portfolio, but weekly is also quite common and also keeps costs low because if you're rebalancing every single day, that can add quite a lot of transaction costs to your portfolio. Or even better, and this is what I personally do, I had a no trade band, meaning I only rebalance when my leverage has drifted more than 5 to 10% from my target. This helps cut down transaction costs significantly, which matters more than people think over hundreds of different trades depending on your portfolio and strategies. Now, applying this whole thing on your particular portfolio is going to depend on how you're kind of running your portfolio. If you're running multiple different algorithms, like per strategy scaling is going to be the most common starting point for you with volatility targeting. Each strategy then gets its own volatility estimate and its own risk budget. But if your strategies are somewhat correlated, you really should be looking at a portfolio level scaling, because the interactions between your strategies matter a lot. And then for a true multi-asset and multi-strategy portfolio, ideally you're using something like a covariance matrix.
He's way over my head at this point, Joe. Let's go over here.
Volatility is low, markets are usually grinding higher. So what does this formula naturally do for you? It reduces your exposure when markets are crashing and increases it when markets are calm and trending up.
There you go. It reduces your exposure when markets are crashing, yet increases your exposure when the markets are going up, which makes sense because remember, you can trade bigger with a smaller stop when volatility is low, and you trade smaller with a wider stop when volatility is high. And there's a question over here, right? I know we follow sit in cash and don't F up in market down scenarios. What would someone who's looking forward to do trading for money? You think I'm trading for like not money? What do you mean someone who's trading for? Of course I'm trading for money. I'm in the US investing championship. I'm not trading for like, I don't know, like earwax. I'm trading for money. What are you talking about? Anyway, in these scenarios, since the money's not, my money's growing. I don't know about you, Joe, you know this was going to trigger me. Here's the deal. You can do whatever the flying flip you want. You can absolutely do anything in the wide world of sports that you want to. But you know what I think you should do is go grab this book on Amazon. Where's it at? Oh, yeah, I got all this cool merch I gotta get out of the way. Hold on. You need to go grab this book like now. Go on Amazon, grab this book like right now, right now. Stop what you're doing. Go on Amazon, buy this book today. Listen, if you need me to give you the $10, I will give you $10. So, well, I'm not going to actually give you $10. Point is, this will be the best $10 you ever spent in your life. Why? Because at this very moment, you are on the cusp of effing up. How do I know this? I've done it. I've been there. I know what I'm talking about. I try to give you all the best information that I possibly can from a fatherly love type perspective to where you don't make the same mistakes that I do. Now, why do I tell you to go buy that book right now? Okay. In that book, he talks specifically about in the market, there are an unlimited number of things to do every single day. But you get to choose which one of those things you do, right? And unlimiting opportunities to do whatever the F you want to do, including F up your account. Not losing versus losing is winning. Yeah. So listen, I understand that you want to do something. If you want to do something, what I'm doing is setting an SGOV, SGOV. I'm getting paid. Trading in the zone is the #1 best ever. It will help break this, right? It will help break those thoughts. He says, I meant it for someone who wants to pursue trading full time. Thanks for the advice, Chris. Dude, I'm telling you right now, go grab that book, put your feet up and read it, find all the books you can, create your trading plans while you can, while the market is in a tough spot right now. I don't know when it's going to come back up. I'm going to sit in cash as long as it takes. In fact, I have a slide about that. I got all the slides, right? As a professional YouTuber / professional investor and friend of Mark Minervini, one of the greatest traders in the history of time, my 6 key trading rules: wait in cash for proper setups, as long as it takes. Now you get to decide. You get to decide what that proper setup is. I want you to know this. So if you got to do something, I would say study, paper trade, come up with a plan, put it in SGOV. There's all kinds of things that you can do that don't involve taking market risk. All right. Does that make sense? I'm trying to talk to you from a little fatherly advice right here. You can do anything in the world you want. I'm not going to stop you. But it's a lot easier to trade when the plan is working for you, when the market's effortless, than trying to fight this right here.
It worked for me, Chris. My swings always had the dip, right? Always had the dip. But since becoming an outlier, it's more of a plateau, right? You make some, you catch it. You make some, you catch it. So it's more like a stair-step approach. So sitting in cash and only being the market when the trend is up is itself a pro tip.
Oh, I missed my cue. Hang on. Pro tip. There you go, Jeff. There you go. Just for you. All right. Yeah, use this time to sit in SGOV, right? I know it's making some money. It's about 4% a year, 4% APY. And yeah, I'm using that in the US Investing Championship right now, right? You're welcome, dude. You're welcome. Like sometimes I can come off really crass and super not cool, but I appreciate you taking the advice because, dude, I want the best for you. I have no Mr. Food Station. Please understand that what will make me the most successful in life is to make you more successful, right? That is the way that Outlier becomes more successful, that you become more successful, is by me giving you everything I possibly can shy of the 82 cents a day to log into Outlier, right? Just play golf while waiting and listen to all my smart mentors. That's a great idea. Although I'm just a random guy on the internet. It drove the point home that I'd rather be rich than right. That transformation changed everything for me. I agree. I agree completely. Let's wrap this up.
Trying to react to measurable risk. You can actually look up some research papers around this, and normally they show on US equities that it improves Sharpe ratios from around 0.4 to 0.5. Now, obviously, that isn't that big of a jump, but on just one particular technique on a lot of capital, that's quite a big jump for Sharpe ratio. It also comes with reduced tail risk and much smoother drawdowns, which is very important. Now, a big caveat here is this primarily only improves your strategies on quite volatile markets like equities, like crypto, etc. On bonds and things like that, it's not going to improve your portfolio that well, but at least in equities and crypto, which most people are trading, it's definitely going to help. And just one other thing, just because there is a correlation between volatility and returns doesn't mean at all times you're going to have, low volatility when the market's going up. Obviously, there's times when there's huge volatility upwards, depending on like news events and things like that. But at least over a long enough time horizon, that's normally the correlation. Now, there are some cons, and I'd be lying if I was saying there's no downsides at all. There are a few things to be aware of, and everything in trading has costs associated with it. So you have to see which ones you're more comfortable with. First, volatility targeting, there is a lag. You're measuring past volatility to make a decision about future exposure. So if the market crashes suddenly from a low volume environment, your formula has probably fully loaded.
That's a great point, right? If and in fact, we could talk about that with silver, right? Silver was growing in volatility, right? So if you put your trade on silver over here, Joe, put that down for me. There we go. If you put your position on over here when volatility is 129, as you're in the trade, it runs up and up and up and up, and now it's at 7.68. You've got a lot more volatility with that trade, and to see it crash down like this, that is a real reality here, right? You've position size back where volatility was low, and now maybe you're still sitting on the same position where volatility is high, but hopefully you've been rolling your position all the way up, which is another ninja hack that being an outlier affords you. Listen, Joe, I got to run. This has been fun. I'll see you guys tomorrow morning. If you're ready to save time, make money, and start winning with less risk, Joe, what do you think they should do?
They should become an Outlier subscriber by going to outlier.com. Or they could try a trial membership for free and then come back and watch one of these videos.
One of those two videos. You guys have a great day. I'll see you soon.